Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending March 29, 2026. So up and away, this is what we are seeing on earnings expectations right now. We have a resilient macro backdrop. We have a resilient macro economy. We have a solid tailwind coming from multiple sources. The synchronized actions of central banks over the last few years, infrastructure spending, defense spending, all of that. And this is carrying markets higher, but for good reasons, because it's earnings expectations that are being revised higher. So we'll dig into that in a few minutes. But before we do, I'll just plug this for a few weeks here, but the macro playlist, this is the new web page that we propose to all of you, mcmahon.ia.ca/en. So if you go there, you will find this review. You will be able to download this presentation, this slide deck. You will have access to our chart of the week, which is the new feature that we put on social media every Wednesday. This is the target date. You will find everything that we write. Our media appearances will be there, and of course our glorious playlist, the macro playlist, which is on Spotify. You can listen to it right on the page, but you can also subscribe to that and listen to it on your own within the Spotify app. So this is where to find us now. One-stop shop macro playlist. This is where you'll get everything that you need. Now, looking at this week's markets, the close on Thursday, so pretty much positive across the board. Focusing on equities, 2% higher for emerging markets on the week, higher by about 24% in Canadian dollars year to date. For the NASDAQ, we're up about 17%, and the S&P 500, 11.5%. So we'll dig into the S&P 500 in a few minutes, but very, very, very solid returns for this date in the year, and also given the backdrop, which has been, of course, very noisy since the beginning of the year. Price of oil down 8%. We seem to be getting close to a deal, or at least an MOU, so memorandum of understanding. So pretty much just defining what they will be negotiating in the next step, but that would come with a total ceasefire. So markets are integrating those news, cheering those news, even though there's still some doubt if that will happen. But still, once it's announced, if it is announced, then the question will be, is it already all in the price? Maybe we'll see then, but for now, markets are cheering these developments. So Canada, first macro news before getting to the markets. Canada has entered a technical recession. So the quotes are important here, for the first time since 2020. If you look at the chart here, GDP is the gray line. So let's focus on that. Q4 was negative, and now Q1 is negative. So two consecutive drops in GDP means a technical recession. But it's technical in nature because you need to focus on what's happening domestically. And these are the blue sticks, and this is called final domestic demand. So you exclude the impact of exports and imports. And in fact, Q4 was very strong, and Q1 has been negative, but we already suspected that, given that we've learned from StatsCan that we've lost 112,000 jobs in the first 4 months of the year in Canada. 91,000 of those are in Quebec, where we're harder hit by the sectoral tariffs. So there's that. Business confidence is hurting, especially small business confidence, and the volatility in these figures recently has been caused importantly by the flows of gold, imports and exports of gold. So of course the price of gold being quite volatile and pretty high, you're seeing some of those flows from consumers, and of course does that correlate with the strength of the Canadian economy? Of course not, but it's part of national accounting, so we need to take that into consideration. But if you focus on final domestic demand, you see some weakness coming mostly from weaker investments, but consumers are doing okay, let's say. So it's not a strong backdrop, but it's not a recessionary backdrop either. By the end of the year, maybe we will start to see some downward revision to consensus growth, which is at about the 1% for the year. Maybe that's going to be hard to reach that, but still, we think this this is a transition. It's not a recession per se. So this is for Canada. Now looking at equity markets. So as I said, 11.5% return on the S&P 500 from the beginning of the year, and it's a bit narrow in terms of market. And the chart on the left shows that this is the rolling outperformance for 6 months of the S&P 500 versus the equal weight version. So the equal weight version is pretty simple. You give an equal weight to every title, every stock in there. Nvidia has the same weight as the 500 stock in terms of size in the index. And when you have an outperformance of the index versus the equal weight index, that means that there is an outsized contribution from some sectors. And when it turns around, it means that it's more balanced. And here what we see on the right is that since the beginning of the year, energy and technology have outperformed. This is the returns versus the index, have outperformed the index by 18%. That means about 30% return year to date from energy and technology. After that, you have a bunch of sectors that are close to the index, from materials to, let's say, utilities. And then you have the underperformers, consumer discretionary, communication services, healthcare, and financials, which are all they are all below the index by between 8.5 to 16%. So it's a net negative performance for financials year to date here. So what that means is that you had to be in the right sector at the right time to beat the index. And this year it was energy and technology. But given the size of energy, which is only 3% of the index, that's not where the kicker was. The kicker was to be in technology. So again, the theme of AI is still a very important theme. The energy, of course, with what's happening with the price of oil, was a solid contributor. But what we are seeing is not just, it's not just multiples, it's not just valuations, it's actual growth and revisions in earnings. And this is the next slide here. Earnings revision continue pushing the stock market higher. Same chart for both left and right. It's just that there is a zoom in on the right. So if you look on the left, so it's the next 12-month earning per share growth estimates, bottom up. This is brought from FactSet. And what you can see is the dynamics. This is quite volatile. But when we exit recessions, that's when, earnings were quite weak during recessions, and then they're getting better. And the pace of growth is revised higher when you get out of a recession. But now we're not coming out of a recession. We're just seeing a solid tailwind from infrastructure spending, defense spending, and of course spending in AI. And this is pushing earnings expectations higher, just like if we had just come out of a recession, but we're not coming out of a recession. So that's very solid. And there's a lot of breadth in here as well. So geographically and sector-wise and all of these. So this is a very solid signal. And if you zoom in the chart on the right, you see that through the earnings season in Q1, you see that, earnings expectations were revised higher again. So the momentum is strong and expectations are actually accelerating. So this is a very solid signal for equity investors here, and it confirms the resilience of the global economy, which is our major investment theme here. So interesting things going on here. So what we'll be watching next week, S&P Global PMIs, net change in employment and the unemployment rate in Canada. Things should be getting a little bit better on the labor market. We'll see. United States, ISM manufacturing and services indices will be out, and we'll have the job figures, which should still be strong. Expectations are close to 100,000 jobs added in the US in May. So we'll see what we get, but interesting week ahead. So again, your one-stop shop now is a macro playlist. So macman.ia.ca/en. You'll find everything in there. If you appreciate the content, please share. Please visit the webpage. And of course, we'll be back again next week.